Welcome to another episode of Breakaway from the Rat Race. And today I have the pleasure of speaking with Spencer Gray. And Spencer Gray is the president of Gray Capital, a multifamily and asset management firm. He has been involved over the years in over $1 billion in real estate transaction, and has built a portfolio of assets over 9,000 multifamily units. So this is very significant. He obviously has multiple kind of like companies. You have Gray Capital, Gray Properties, and all of that. And you can kind of help us sort through this if this is something that's important. So Spencer, welcome to the show.
Eric, really appreciate it. Thanks for having me on. Yeah, I've been looking forward to this.
Excellent. So tell us a little bit about your journey, because I think this is, when you talk about that Gray Capital 9,000 multifamily units, this is very, very significant numbers for someone who seems a little bit younger than me. And so how does one get to that level, or maybe how someone gets started in this? And I think maybe if you share a little bit of your journey with us, I think that might help us.
Yeah, no, absolutely. Well, and I guess I'll say from just the onset that I didn't necessarily have a goal of, all right, let's go for 9,000 units or 10,000 units or even 1,000 units. Really it started, and this was once I was making transition to really focus on larger multifamily assets, but it was really trying to just get in the business and get started. And I wasn't really sure where the next what the next steps were, but I just wanted to make progress in the industry and try to carve out a niche. But so maybe kind of rewinding back, a few more years. I've always been a passionate entrepreneur. I got involved in real estate early on in life. I had the opportunity to help a friend flip a single family home back when I was in high school. I was only 18 years old. I had no idea what I was doing. I don't think my friend did, but his father, he was an attorney. He had been flipping houses just prior to the great financial crisis. He's like, I'm going to teach my son how to do it also. So I got wrapped in. We really didn't make much money off of that deal, but it planted that first the seed in my brain kind of was that initial spark of opening up my mind to real estate. And this was something that I could always kind of do. And at first I thought that, I might have a different career, but I might always be doing something with real estate on the side. Might always be flipping a house, having a couple of rentals. And I didn't even understand the concept of, multiple income streams or anything like that. It just seemed like it was a smart thing to do. I knew, relatively wealthy people, that that's what they were doing. So it's something that I should do for myself. But real estate wasn't the primary focus. It was just kind of this thing off to the side. I was focused on, so my degree, I was a music major in college. I worked in recording studios. I was writing music. I was a recording engineer. And I was trying to make a business out of that. And as most people who get involved in the music industry figure out, and I see you've got a guitar behind you, so you make more or less, but it's an industry full of passionate people, not necessarily full of a lot of people making much money. There's certainly people who do make a lot of money in it. And I was passionate about it, but I was also passionate about building a business and being an entrepreneur. And I couldn't really figure that second piece out. So, I'm like, I still play music to this day, but I've decided, quite a few years ago that music wasn't going to be my path to really financial freedom. And around that period is when I started kind of figuring out, how do I create financial autonomy, financial freedom, and really just how do I live the life that I want to live, and how do I provide a life for, my future wife and, maybe my future kids. And so I was looking at other business opportunities, and I founded a business in the craft beer industry, brokering hops and hops products from farmers to craft brewers. And we quickly, I kind of stumbled into the business. There was an opportunity. There was a hop shortage at the time. And within a year period, we had grown to the fastest growing hop broker in the United States, the largest in the Midwest, and only owned that business for about 2.5 years when we decided that we were going to sell the business. And at that point, we were looking kind of for the next step. And real estate kept coming back. And I was reading a lot of books, listening to podcasts, and I decided this buy and hold strategy specifically for larger apartment buildings was what I wanted to pursue. And again, it was part of the process of just networking, meeting individuals who were just doing what I wanted to do that led me to forming quite a few partnerships with folks that were in the industry that knew a lot more than I did, a lot smarter than I was. And I've been very fortunate to be able to learn from some of those individuals, partner with them, co-sponsor projects, and eventually led to creating Gray Capital, which is a multifamily real estate investment firm, an asset management platform. And we work with investors all across the United States, investing in large apartment buildings.
Excellent. So this is a few things that are, I think, very important is that often people are saying, well, I don't have the right education. I'm not a lawyer. I'm not in finance and stuff like that. You studied music. So
exactly.
So this is obviously, sometimes I complain that, the education system is just preparing you for a full-time job, not really preparing you for what you're going to need in life and to build a real estate portfolio that's going to help you with your retirement. But yeah, music major. I think this is. I think we've squashed the
the myth and the fallacy.
Exactly.
Yeah. No, I mean, you talk to so many people who, their degree just doesn't line up with what they're doing in their career. And I would say real estate, I mean, it's one of the best examples because at the end of the day, it's not what we're doing is not rocket science. I mean, the idea of, finding a property, putting together a business plan, it's following a process and steps and requires you to be diligent and to be smart about what you do. But we're not designing a rocket to go to Mars. We're not even designing, a car or anything like that. We're not reinventing the wheel. And so it's more about, who you know, how do you get out there, how can you network, and can you make something happen? And so it's much more of those personal skills. And I'd like to think that I use some of my creativity that I used when I was doing music all the time to being able to put these deals together, look at things a little bit differently. And it's pretty exciting from that standpoint.
So yeah, I guess also in music too. I mean, you kind of this is pretty interesting too because it is really everything you do. Like when you play with other people, it is a partnership. It is a balance. It is it's listening to the other people and then kind of like reacting, contributing to what they're doing. And so this is pretty. I mean, I know it's music, and this is basically what you do in business as well. I mean, you kind of see what your partners are doing and stuff like that, and you support, enhance, contribute in order to achieve the same goal. Which so that I think from that perspective, philosophically, I think you can see that this would make sense.
Yeah, no, I don't think I've ever thought about it just like that, but I think you're right. I mean, it really is. I mean, it's like you're playing in an ensemble, and whether it is listening and knowing, or you have to know your part. You also have to know, how loud to play, how soft to play, not to get on anybody else's toes, and it's communicating, and and also music is mostly math and ratios, and a lot of this stuff is too. So I think there's a lot of good analogies.
Sounds good. So hop broker, this is phenomenal story as well, like how you got started into that and then build the company. So this is where you had to learn everything from scratch. I mean, besides maybe you drank some beer and you knew there was hop in it.
That's about that's about as much as I knew when I got started. Yeah, no, literally it was. Yeah, we're drinking some craft beer, and there were all these new breweries that were opening up, and we said, okay, well, there are all these local breweries. Are they getting local ingredients, and how are they getting them? And then we just started having conversations and found out that all these breweries were having a hard time actually sourcing a lot of their ingredients, and specifically hops. And we had originally approached it from a standpoint of, can we actually grow hops here in Indiana? And we did have a hop farm. We were the largest hop farm in Indiana at the time. It was small. It was only 5 acres. But the primary business, because we figured out, all right, well, we don't know really if we can grow hops in Indiana. We can start a business today on brokering hops from existing brokers, and we could actually make some money doing that. And basically, the market was very inefficient and slow. It was the kind of an old industry, the hop industry, where they had only been selling to Anheuser-Busch, Heineken, and Miller Coors, and didn't really care about this 1,000 new customers that had popped up. And we said, well, let's make a niche focusing on that new 1,000 small and independent craft breweries, and kind of carved out the niche. And we're kind of the independent hop broker, I guess.
Yeah, and also I
So
think, I think when you're doing the Anheuser-Busch and all this kind, I mean, they want to have like a very generic kind of hop for their beers. And now with all the new craft beers that are coming out, you have a variety of of different hops that are adding all kinds of different profiles to the beer.
exactly.
And I could see that this is where you would want to carve a niche, and then that's catering to the smaller brewers, and then so I think that's fantastic for you to have found this opportunity and then grow the business into that
Yeah.
from nothing. Yeah.
Yeah, and it is, and I think what your earlier point is, really kind of that ramp up in knowledge. I mean, I knew
Yeah.
basically nothing about hops, and basically gave myself a crash course on how to speak the language of one farming. My family has been in agriculture, so I knew a little bit about farming, but nothing about hop farming. And then brewing, I knew a little about beer, but I didn't really know about the brewing process. And then to sell hops, I have to basically learn all of that. And part of it is you kind of have to fake it until you make it, and it was figuring it out. But I think I had a good team that I had surrounded myself with, and we were all very quick learners. And I guess to make the transition back to real estate, I mean, it's the same thing.
Yeah.
It's ramping up that knowledge to real estate, because I didn't go to school, or I didn't get my degree, at least in real estate. I've taken some courses and I've educated myself. But I think it goes to show, if you really want to tackle something, you put the time in, the resources are out there. I mean,
Yeah.
the internet today, it's all there. So
Exactly. And then I think you mentioned the team as well, kind of like the having a team around you that can help you and support you with the knowledge that you don't have, or the time, or money that you don't have, other resources that you don't
exactly.
have. Yeah. So I focus a lot on resources. Sometimes it's about time, sometimes it's about money, sometimes it's about skills, or sometimes it's also access to information and whatever. So yeah, I think this is very important. So then you decide to pivot out of the hop broker business, and now you decide. So what made you decide? What made you decide to go to real estate? Was that just? It seems that it was kind of you were looking at other people and how they were doing.
I knew some people that were in the real estate business, and I had since I'd flipped that house in high school, I was always paying attention. Again, so always flipping a house on the side if I had some extra time and money, and I was trying to dip my toe in. Even before I started the hop business, I had looked into investing in apartments, but just never pulled the trigger.
Yeah.
And once we were in the process of selling the hops business, it was really looking for, okay, what's that next thing? Well, okay, what's the next project? And my CPA floated an apartment deal over to me. He had a client who was selling some apartments, and I never really fully, underwritten a large apartment building. And he was like, just take a look, see what you think. He basically saying that this guy had made a lot of money over time with just a handful of apartments, and it just seemed really interesting. And it just kind of started this process of learning more about it. We didn't make an offer. We didn't really pursue that project, but it just opened up the door to, well, maybe let's talk to a few other people. And I'm going to read this book. And then it just kept snowballing of just consuming information and networking and trying to expand my network, 6 degrees of separation. Okay. Who do you know? Then who do you know? And then who do you know? And all of a sudden I was talking to all of these, big real estate players in the Indianapolis market, which is where we're from. And all of a sudden I just had a much more, I guess, clear landscape of, what's going on, what I can do, and just, what's out there.
Yeah. Okay. And then you kind of like figure it out. Obviously you had, with the hop business or any business, you kind of have to figure out kind of like some numbers, some ideas of numbers and stuff like that. So how did you pull up these numbers? How difficult or how different was it to pull the numbers for an apartment, your first apartment building deal, compared to, your hop business or something like that?
Yeah, it's a good question. Because in the hop business, I had another partner that was really kind of the numbers guy, I was in the numbers, but I wasn't like fully into the weeds. But in the real estate, that's when I really started getting into the numbers and really started learning Excel and just diving in. And that's where I've never considered myself a math person ever until I really got into real estate and I started really liking it. And I almost gamified underwriting real estate projects. It almost became like playing like a computer game or something, because you had all these options, all these levers you could you can manipulate.
Yeah.
And I just started getting really into it. And so it was a process. I mean, I first started using, the bigger pockets, rental property calculator, as basic as that was, because I was like, all right, I just need something to kind of get me started. Then I realized what I wanted to do required a lot more, complicated, underwriting model. And so I started just teaching myself, okay, well, I need to figure out how to do this. I can't just borrow somebody else's model. I have to see how all of these numbers work. And so I built my own model. And by this point, I was working with a couple of other real estate groups, syndicators, doing a lot of co-sponsoring of their projects, and also investing as a limited partner with a few others. And so I was seeing how they were underwriting projects, and I was just getting involved from a very early standpoint in their deals, and from saying, I want to go on tours with you guys. I want to be involved in due diligence. I want to see your underwriting from the beginning, because I knew I wanted to do this for myself at some point. And so just learning how different groups underwrote, how they approached a project, I kind of blended everything I was learning into my own kind of synthesis of what I wanted. And then it finally got to a point where, fast forward, and we've really founded Gray Capital, and we're doing our own deals, and we've hired our own director of acquisitions, where I took the model that I had been working on for years, and I said, okay, let's maybe not throw it completely out the window, but let's redo it. Let's make it better. And how do we continue to improve?
Yeah, that's right. Because I think some people, they're asking me kind of, oh, send me your Excel spreadsheet or your template for underwriting apartment buildings and stuff like that. And so I can give it to you, but it's going to be a complete waste of time, because you're going to spend so much time trying to figure out what calculations I'm doing and where it's coming from. And it serves my purpose and my process. Doesn't mean it's going to serve yours. And so I encourage people to just start doing your own model and stuff like that. Look at other models as well and plug it into yours and see how the numbers compare and stuff like that, and enhance based on what you see. But yeah, I think it's much better to create your own than that, that intimately what the calculations are.
I agree.
Instead of borrowing.
Because it looks intimidating, but it's addition, subtraction, multiplication, and division. I mean, that's it. I mean, a couple of formulas, but it's, you can find those, you hit the equals, but they pop up. It's not that complicated. Exactly. So yeah, I would encourage everybody to just try it for yourself.
Yeah. So tell us about your first deal. Tell us about that first deal.
Yeah. So the first multifamily deal was, we sold the hot business, had been networking, just kind of, it was an accumulation, all this effort of trying to figure out our next deal. And first wanted to do our own deal on our own, but then I realized I'm not smart enough for that, or there's people with more experience. So I decided that we were going to partner with somebody who was a syndicator. And we came onto the project as a co-sponsor and as a co-GP. We contributed a decent amount of capital. We helped guarantee the loan, and kind of in exchange saying, I wanted to be intimately involved in the process and kind of in the ditches with you guys. So that was a 220 unit apartment community in Indianapolis, kind of in the Speedway, Indiana submarket in Indianapolis. And we actually just closed on that property a little less than a year ago. But it was a pretty deep value add. It was built in 1968, I believe, and it was about a $8,000 per unit. Pretty much a full gut of the interiors, kind of fixing them up, bringing them to a nicer level. And a lot of lessons learned. One was my first big deal, but it was also the biggest project that our partners had done up to that point in time. And it was a good lesson on err on the side of overcapitalizing on a project where there's going to be a lot of repairs that you're going to run into, because go in to fix one thing and three other things would break, and you got to have the money to fix it at the end of the day. But ended up being a successful project.
Yeah. So I think partnering at the beginning, especially on a bigger project and stuff like that, I think it's definitely, to me, I call that risk management. Yeah. So that, at least I'm not 100% responsible for all the risk. If something goes bad, then we can look at everything. But how did you find that other partners, that other sponsor? he was looking for you to bring you on as an equity partner, or how did that work out?
Yeah, so it was an interesting introduction. So I was actually speaking with a lender. I was interested in a certain type of financing, it's HUD 223F financing vehicle, and the lender said, "Yeah, it's a great financing vehicle. The property you brought in to show us, would qualify, but you don't qualify. You don't have the experience. You can't get this loan." And I was like, "Okay, well, how do I get the loan?" He's like, "Well, you have to have some experience." I'm like, "Well, how do I get experience if I can't get the loan to buy the property?" And he said, "Well, if you partner with somebody, you can piggyback on their experience and you can start building that track record." And so that was like the real aha moment of like, not only it may be a better idea to partner with somebody, to your point, for really risk management, but also it may not even be an option to do it on my own. So he put me in touch with this other operator locally to us in Indianapolis, saying, you guys should meet. Maybe it works out, maybe it doesn't. Since that meeting, I think we've co-sponsored 10 different multifamily syndications together. We've bought almost $500 million worth of real estate together, kind of since that initial meeting. And so, when we're working on projects together right now. So it's been a very successful partnership. But it wasn't overnight to kind of get to the point of we felt comfortable with each other either. It was probably a year process of having lunches and meetings, and him wanting us to come into his deals, primarily as an equity partner, but us being resistant, saying, "Yeah, we still kind of like the idea of doing our own deal, and I don't know if we want to give up all the control just yet." And so then one day he's like, "Okay, well, what if there's this other," he's like, "What if, I brought you guys into the general partner side, be a co-sponsor?" And that kind of opened up our eyes to the economics of how these deals are really put together, and what's the difference between being a limited partner and a general partner. And, what if you're investing as a limited partner, but also have a piece of the general partnership, what all that looks like. So yeah, it's pretty interesting.
Very nice. So what would be some of these, I would say the recommendation you would give for someone that is looking to invest in multifamily? So what's the recommendation? I mean, for you, that's a big jump, I think, what you've done for most people. And I think what warmed you up to that idea was that you had just wrapped up your other business. And so you felt pretty confident that, okay, well, we need to invest in something else. And then real estate, what was it? And I suspect you probably had a significant amount of capital that you were able to build. Some of the people, the listeners that I have, they don't have that much capital in play.
Yep.
They might be interested in doing multifamily. So what are some of the recommendations or guidelines you would give them to get started?
Yeah, no, I think you made a couple of good points, and most individuals aren't as fortunate as the position I was fortunate to be in, where we did have some capital to invest, and I'm kind of just off of a successful venture, so we kind of had a little bit of momentum, and all right, we're looking for the next thing. But it comes down to first, what are your real goals, and when you're trying to invest in real estate, because there's no reason to invest in real estate just to invest in real estate. What are you kind of getting out of it? And whether you are approaching retirement, or retirement is far down the road, your preference for cash flow or overall growth and appreciation, you may be kind of on one side of the coin or the other. And so for folks who are really looking to generate passive income, and they're looking for that cash flow, multifamily properties are a great vehicle to produce that. That being said, not every real estate investment, not every multifamily investment is necessarily going to gear towards throwing off a lot of cash flow. There are some projects, whether it's new development, or even like a major renovation, where there may be no cash flow for the first couple of years in the project. So it's important to know that just not every multifamily real estate syndication or investment opportunity is really created equal. They have different return profiles, and to determine what you're really seeking. So again, if you're looking for cash flow, you want to look for projects that do have a degree of cash flow. But then taking maybe a step back, making sure that investing as a multifamily or any kind of passive investor, it's not a get rich quick process. You're not going to become a millionaire, even if you have, $100,000, it's not going to turn into $1 million overnight. And, most people don't even have $100,000 to invest. And so, I speak to investors across the spectrum, from folks who are, still in school trying to figure it out, to, folks that are in retirement who are, ultra not high net worth individuals. And, I'm talking to someone that's younger who might not have, $10,000 kind of saved up. I'm like, well, multifamily syndication, one, you may not even be able to participate because of the minimums, but it's not going to get you where you need to go. And you may be wanting to look at investments that have a higher velocity, where you can kind of turn that money multiple times, whether that's flipping houses or something that you can build that nest egg so you can invest, whether that's actively and you're doing your own project and maybe raising more capital, or you've been able to build up such a nest egg that you are investing it passively. But investing passively into a large real estate offering, it typically means that you already have a decent amount of savings to actually invest. And so that's where I tell a lot of people, it's not necessarily the right fit for everybody. It might make sense for you to go and buy, whether it's a single family home or, a duplex or something that you can control, that if you only have $25,000 or $50,000, that might be a better investment decision. For other folks, they don't have the time to manage anything on their own, and they're looking for something that's, purely passive. And so maybe a syndication or more of a turnkey option makes more sense. So it's not a one size fits all. Everyone's a little bit different in the kind of the solution.
Yeah, that's right. And I think it also deals with kind of like your personality, what you like to do, what you like about real estate. I mean, just a lot of people out there, they don't want, like, even though they have property management in place, they get stressed out when they see that the property management sends some guy to change the light switch for $50, and they get upset by that. Well, this is life. This is what's going to happen. So if you don't like that, if you get very nervous or you lose sleep over the fact that your tenant didn't pay the rent yet, and it's like it's June 15th, then if you're going to lose sleep over that, then building a bigger portfolio is not going to make it any easier.
Yeah, no, that's a good point. And you really can't, real estate, you just can't sweat the small stuff. And and if you do, being in a position where you're just not exposing yourself to the small stuff, or an investment that you're just don't have those worries.
It's also a little bit of leap. I mean, we talked about risk also earlier, but it's also a leap too. Like, you have to tell people, say, okay, well, you have one property right now, you have one single family rental, and in order for you to minimize risk, you have to buy more. Buy 5, 10, 20. It's like, what? No, I can't. I already can't sleep with one property. But kind of explaining that if you have like 5% of your properties are vacant, and it's not as bad as having 100% of your properties vacant. And so that's also kind of like a leap of faith, or to me, I call it a leap in logic. Is that if you look at the numbers, it's better to have multiple units to deal with.
Yeah, no, there's safety in numbers, and I mean, because we'll still look at we mostly target properties that are really 150 units, really more closer to that kind of that 200 unit mark, and because we've invested in 30 unit properties and even 100 unit properties. And even, one tenant leaves, it's at 100 units, only, 1%. That's not big of a deal, but, it still moves the needle a little bit compared to, even a fourplex where it's, 25% of your occupancy. You go from fully stabilized 100% to, break even with one individual. And we've got a 36 unit that's a pretty high end project here in Indianapolis. It was a condo deconversion that we did, but each unit's 3%. And, so it moves the needle pretty quickly one way or the other. But, on our 250 unit communities, it's just a day in the life. It's business as usual. Somebody moves out, somebody moves in. You're just always leasing, and you're always turning units. So safety numbers for sure.
Yeah. And for me, like when I talk to my investors too, and I look at resources, what resources they have available, and most of the time is a critical component. They're working full time. They want to achieve financial freedom. So you want to find an investment vehicle that's going to be kind of a hands-free. It's going to be truly passive and start building into that. I see a lot of investors that are kind of making the mistakes of, oh, and I'm going to do a flip, or I'm going to do something, and then it's going to take so much time for them to do it, and the risk of making mistakes is is significant. So
Yeah.
just save a little bit, invest in something that's truly passive, and build that portfolio over time. Keep your full-time job. Once you get at 80% of your expenses, of your living expenses that are paid through passive income, then you can kind of like take a back seat or quit your job or whatever, and then kind of delve right in and be full-time in real estate.
Yeah.
And then you can look at opportunities that are more time consuming. And so that's kind of my recommendation.
No, I think that's spot on. But, and even in real estate, I see opportunities in real estate where I'm like, I'm so focused on my niche and my sector that I can't take myself away from focusing on what I'm doing. And I'll invest passively as a limited partner in other asset classes because I want the exposure. And I think it's a great deal. But, like medical office buildings, for example, I've been investing in. And I mean, I understand the process enough, but I'm not an expert. But I found some great partners that I can kind of just throw some money over there with.
Exactly. That's a great example too. Having the right skills and stuff like that, and being able to is very different to rent to a regular tenant compared to a doctor or something like that, or a dentist in a medical office setting. It's completely different. These are commercial lease and all of that, and the building has to be a certain standard in order for it to qualify. So so having the right partner in that case, if you don't have the right skills, then it is definitely critical.
Yep. And then also just time, and that's really what we're going after, is trying to achieve more time and finding ways to leverage more time. And even, from a diversification standpoint, I'll invest in other multifamily syndicators offerings too, just because I want to be diversified, from myself. I can't just be only investing, in what I'm doing. I mean, that's my preference, but somebody may be out in the Southwest somewhere where we're not operating in, and I want some exposure out there. And again, it's a way for me to just leverage have my money create more time for me. And so I'm able to be more active without actually having to dedicate more time.
Yeah. And I think part of the complexity of that, finding the right multifamily. If you don't have them in your backyard, I mean, you're lucky enough, you live and invest right in your backyard. For me, I'm in California, and investing in cash flowing multifamily or even single family rentals here, it doesn't make sense. Yes, they can cash flow, but you put so much cash into the deal in order for them to cash flow that the cash on cash return doesn't make any sense. You're at like 1 or 2%. Then might as well buy treasury bills. Getting into the right market, getting the right information. I think this is something that's very, very important. And I think that you have something that's called grayreport.com. And I think you kind of like aggregate a whole bunch of information about real estate, different news about the real estate. And then do you provide that for free?
Yeah, so it's all for free. And, it started, we have a newsletter. It's called the Gray Report newsletter. You can sign up, graycapitalllc.com/newsletter. And it was every week we were aggregating, all the biggest articles and research reports from the multifamily industry. And it was really for the research report side that got us, that really drove us, because, all these brokers and research companies, they put all these market reports. They don't always do a great job of disseminating the information or announcing they've released the reports. And I hated seeing that something had come out like a month or 2 months ago and I had missed it. And so I told my team, I want to do a really good job of aggregating all of these, staying on top of it, and let's send them out to all of our clients or all of our investors, part of our newsletter. And then it got to a point where we had all this information coming in. We had all these different RSS feeds. And I said, let's put this all on a website. Instead of just sending it out an email once a week, because like we're doing like it's year 2002 or something. I was like, let's make a website like we're at least 2005 or something. And so we created a website. It's called grayreport.com. And it's curated content, but also we have a lot of just automated, RSS feeds, bring in any kind of article, research report, opinion, but also podcasts, YouTube videos from multifamily industry, the economy, and just real estate in general, all in one spot, completely free to use. There's no advertisements outside of, a little bit, something for Gray Capital. But yeah, it's grayreport.com, and I encourage everybody to check it out.
Sounds good. And so we'll definitely, I'll put that in the show notes as well, obviously. So before we wrap up, anything else, any famous last words for investors out there who want to get started in multifamily and how to reach you?
Yeah, well, easy way to reach me. You can just Google Gray Capital. Our website should pop up at the top, graycapitalllc.com. Feel free to connect with me on LinkedIn. We're on Instagram, kind of all social media, Bigger Pockets, all those places. And I think this is one of the most exciting times to be alive, and real estate, multifamily, being an investor in anything. I mean, getting out of the coronavirus pandemic. It's a fascinating time, to say the least, and I think maybe premature to make too many conclusions, but I'm more optimistic than anything kind of going forward. So, but I think it's gonna be a wild ride, to say the least. But just all make sure that we're allocating ourselves to the right assets, and let's get ready for a ride.
Yep, exactly. It's gonna be very interesting. Always very interesting.
Yep, yep. As is life.
Yep. So, well, thank you very much, Spencer. Enjoy the rest of your day. Thank you for sharing your information and your experience with us.
Hey, really appreciate it, Eric. Thanks for having me on.
Thank you for listening to Break Away from the Rat Race with your host, Eric Martel. If you want to share your story and experience with our listeners, please message us on Facebook at Break Away from the Rat Race. Also, please subscribe to our YouTube channel and our podcast on iTunes.